What's up guys, it is Devin here. Welcome back to my channel. In this video today, I'm gonna share something with you that I get a ton of questions on. I'm gonna answer how policy loans work with life insurance and why policy loans are the best loans you could possibly have. You almost wanna view them as an asset, and I'm gonna get into exactly why that is. In this video, if you get value from it and you have not subscribed to my channel, make sure you do that. Hit the bell so you get notified when I put out these videos. Like and comment. I will respond to all the comments. Make sure to do that. Let's jump into how policy loans work with life insurance. So I'm sitting here thinking, what is the best way to explain how a policy loan works? And I think the best thing for me to do is to first explain what a policy loan is. That's very, very important that you understand what it is first. So check this out here on the whiteboard. So the easiest way for you to understand what a policy loan is for me to give you an analogy. First and foremost, I apologize for my drawing skills. They're not the best. Bear with me on that though. You've got a house, okay? Everyone understands when you make payments on a house, so mortgage payments, you build equity in the house. Also, time is going to build equity in the house. What I mean by that is the longer you have a house, generally speaking, it's going to go up in value. So as you build equity from those two things, you can borrow money from the bank. The bank will give you a loan and they're going to use the house as collateral, okay? So the thing about it is the bank knows that if you stop making payments, they can take the collateral. So they have a lien on the property. Life insurance is very, very similar. The house, the collateral, is your money that you're putting into it. So your premium payments, those are giving you equity in the house. Also, time is giving you equity because with life insurance, it's guaranteed to compound and grow. So the longer you have it, the more equity you have. Now, what you're doing essentially is you're putting money into the house, the policy, you're building equity in it, and then you're borrowing from the insurance company. So think of the insurance company as the bank, your money as the house, the collateral. And what the insurance company is doing is they're letting you borrow from their general funds. And what they're doing is using your money as collateral. What you're borrowing is simply your future death benefit. So think of it as the equity you're building is equity inside of this future death benefit. So when you put money in and you have cash value, that's your equity, it's slowly growing into the death benefit over time. The insurance company is simply letting you borrow the death benefit while you're alive using your money as collateral. And that is a really good thing because that means that your money is not leaving your policy. It's continuing to compound and grow 100% tax-free, and then you can go use the money for whatever you want. Now, policy loans are the best loans there are because of a couple things, and I'm going to share that with you at the end of the video, so make sure you stick around. Now, a lot of what I talk about on my channel is infinite banking, becoming your own bank. And really, if you think about it, the bank is the ultimate trump card when it comes to real estate, when it comes to anything. Banks always make money. And why is that? They treat loans as assets. Really think about what a bank does. They get deposits. People deposit money into the bank. That bank immediately takes the money and lends it to other people. Why do they do that? If you put your money in a bank, deposits are viewed as liabilities because they have to pay you an interest to hold your money. So they simply take the money and lend it for more than what they're paying you. And they keep the difference. They're very good at this. As that money comes back with interest, they simply lend it out again. And the more that they do that, it's called the velocity of money. The more that they move the money and put it into more loans, they're turning those loans into an asset for one, money that's coming into them instead of money that's being lost. Being lost is a liability, money coming in is an asset. So they're turning these loans into assets, and the more they do it, the more profitable they are. So you want to start viewing policy loans the same way. You want to become your own bank so that you can turn these loans into assets. Let's talk about how that works. So be your own bank. You're funding your life insurance policy to build that equity in the house so that way you can borrow the insurance company's money. Think of it this way. When you're putting money into a traditional bank, the bank is using your money, they're controlling it at a cost. That cost is what they have to pay you. So you are doing the same thing with a life insurance contract. You're borrowing the insurance company's money. So you're doing the same thing the bank is doing. You're borrowing that money at a cost, and then you're sending it out to work to make you more than what it's costing you. Same thing the bank's doing. They're paying you an interest rate. They're lending it out and keeping the difference. So you want to fund your policy, build up the equity, and then borrow that cash value. So you got the cash value, you're borrowing it at a cost, and then you're putting it into an opportunity. Okay. So the opportunity could be an investment where you're going to make a rate of return. The opportunity could be paying off debts or any major purchases. Now, the two things you're doing here is you're acting just like a bank. What do banks do? Again, very simple. They get deposits. They have to pay you a little bit of interest. They're lending the money out for more than what they're paying you. As the money comes back, they made a spread. They're lending it out again. As it comes back with interest, they're making a spread. They keep doing that over and over and over and over again. So you just want to treat your policy the same way. You're putting money into it. You're becoming your own bank. You're building equity. So now you're borrowing that equity at a cost, and then you put it into an opportunity. So let's say the opportunity is an investment. That investment, let's say it makes you 10%. That 10% return, you flow it back to your policy. So now what you're doing is you're paying down that policy loan. And as you pay down that policy loan, you immediately have access to those funds again. So now you can lend it out. You can make another policy loan just like banks do. And you can keep that cycle going over and over and over again. If you're paying off debts, let's say you pay off a debt that's 25% interest, a credit card. Now, if you pay that debt off with your policy and you simply take the payment you used to pay and flow it back to your policy by paying down the loan, you're now recapturing all the money you used to pay off the debt plus the interest that you were paying them. You're recapturing 25% interest. Now, the only thing that's required from you is the borrowing rate to do it. So it's just like a bank, right? The bank is using our money at a cost. They have to pay us, and they lend it out for more than what they're paying us. In a policy, you're borrowing from the insurance company at a cost, and then you're loaning it out. You're putting it to work for more than what it's costing you, the borrowing rate. The whole time you're doing this, all the money you're putting into your policy is continuing to compound and grow 100% tax free. So that's really, really important because think about this. If you're compounding your money, that means that your balance is going up. So you're always earning more interest, guaranteed inside of a policy. Now, if you're practicing infinite banking, so if you're putting into different opportunities and you're flowing the money back to the policy by paying down the loan, what's happening is you're paying down a simple interest loan. Simple interest just simply means as your balance goes down, the amount of interest you pay goes down. So if you're constantly doing this and constantly flowing money back to policies, you're constantly lowering down your loan balance, paying less interest to the insurance company, paying less control cost. And then the beautiful part about it is you're always able to borrow more because your money continued to compound the entire time. As promised, I'm going to share with you guys why policy loans are the best loans, hands down. There's a few reasons for it. First reason is that the insurance company is playing the long game. They're figuring that you're going to live a really, really long time. It's not like, rates in the market where things go up and down and sideways. It doesn't work like that. The rates, they change very slowly. So I've been doing this now for about 5 years. And generally speaking, the rate stays right around 5%. Again, that's simple interest. Now, what happens is when you do a policy, you have an anniversary date. Let's say that date is March 6th. I'm using March 6th because that's my birthday. So anyone that's watching this, save that in your calendar. Wish me happy birthday next year. I'd appreciate it. So March 6th, let's say that is the anniversary date of my policy. What's going to happen is whatever the rate is at that time with an insurance company, that'll be the rate for 12 months until your next anniversary date. So then what's going to happen is on March 6th of the next year, whatever the rate is at that time, it'll be that for an entire year. So it doesn't change often. Again, it's usually right around 5%, and it's got a cap. It can never go above 8%. So that's one reason that policy loans are the best, because they change slowly because the insurance company is playing the long game. Another reason why they are amazing is because the insurance companies that we use, they're mutually owned. And that means if you have a policy, you're a part owner of the business. So when you pay an interest rate to the insurance company for borrowing their money, you're helping that insurance company become more profitable. The more profitable they are, the bigger of a dividend you get with your policy. Dividends raise your cash value 100% tax-free, and they also give you a little more death benefit. So that's incredible. That means that you have an ever-increasing cash value. That's money you can use to go practice infinite banking, and you have an ever-increasing death benefit. So the older you get, the more you use your policy, and the longer you do it, the more time you give it, you're getting a bigger death benefit as well. So your family, eventually when you pass away, is going to get a huge death benefit payout tax-free. So that's another great thing, is when you're paying a policy loan, it's going to a company that you're a part owner in. That's incredible. The third thing, and this is probably the best thing, is when you take a policy loan, it is an unstructured loan. Think about it. Most every loan we think about is, I've got terms. I've got to pay X amount every month on time for 5 years, 10 years, 15, whatever it might be. There's terms to loans. With life insurance, it's unstructured, meaning there's zero terms. The insurance company knows without a doubt you are going to pass away at some point. I'm going to pass away. Everyone you know is going to pass away. It's inevitable. So if you never pay your policy loan back, all that's going to happen is they're going to deduct what you didn't pay back from your death benefit when you pass away. Because remember what I said, guys, when you're borrowing the debt, or when you're borrowing the insurance company's money, they're just basically giving you the equity you have in your death benefit. So if you never pay it back, they just reduce it by whatever you didn't pay back. They'll never not get the money because you're gonna pass away at some point. So you either pay them back tomorrow, or you pay them back when you're 80, 90, 100 years old, whenever you pass away. So what does that mean for you? That gives you 100% unhindered control. You decide whether you pay the loan back. You don't have to. Paying the loan back is a strategy. It's a part of the infinite banking concept. If you constantly pay your loans back, you're lowering the balance, so you're accruing less interest, and you're putting the money back into a place that you have access to again, that never loses value, and it never leaks money to the IRS. It grows tax-free. So if, let's say, you're recapturing 25% interest you were paying on a credit card, like I had mentioned, that's 25% more money you're getting into a place that grows tax-free that you were losing before. When you pay interest to somebody else, that's money you'll never get back. You'll never get it back, and it'll never earn you interest or money ever again. By practicing infinite banking and by recapturing the money and always paying the money back to your policy, you're getting more money into that place that grows tax-free. And the beautiful thing is, if there's hard times that come, you don't have to pay the loan back. So if you go buy a car with your cash value and you lose your job, you can't make payments back to your policy anymore for the car's not going to get repossessed. You own the car. You used your death benefit to buy the car now. So guys, it's a beautiful thing. Policy loans are not difficult. It's just a simple interest loan. You're borrowing from your future death benefit using your money as collateral. Your money, it keeps compounding and growing. So I hope you guys got so much value from this video. Share it with anyone and everyone who has ever wondered how these things work. And also put your questions in the comment section. I'll make sure to get back to those as soon as possible. Subscribe to the channel if you haven't already. Like it, hit the bell, all the things. I appreciate all you guys. Until the next video, peace. Love y'all.